Hi fighters, how you doing? Travis here from Carter Cow Capital, helping you fight for your financial freedom throughout the Forex market. Today is Wednesday, so it's a Wisdom Wednesday, and there are three things that I want to go ahead and talk about. And this is more suited for a person that's getting into trading, not necessarily someone that has been trading for a while. But in the comment section below, if one of these three things has affected you in a negative way or a positive way, please make sure that you end up placing in a comment. That will help out the people that are just getting started, to give them confidence that these things can be avoided. Now let's get into it. The first thing that I want to talk about is this: when entering a trade, you need to have 3 entries at all times. Once again, I'm going to say that when entering a trade, you need to have 3 entries at all times. You need to have the limit, which means that's the price that you're actually getting into. You need to have a stop loss, which is the desired amount of money that you're willing to lose. And you need to have a take profit value. The take profit value will end up being whatever pips that you're going after on that move. Now, a couple things can be intertwined with this. If you don't necessarily trade with a take profit number because of your trading style, then you need to have a trail stop added along with it. Meaning that you may not have a desired take profit number, but the trail stop will end up capturing pips and take that stop loss into break even along the way. Now, if you end up having a take profit and a stop loss, then it allows your stop loss level to break even and make it a free trade while it's actually moving. And if it was to go away from you, then you'll end up making the amount that the trail stop end up capturing within that point in time. But at no point in time you should have a trade that is set up where you don't have a stop, because the market is so violent and it does whatever it wants to do, whenever it wants to do, and however it wants to do. And guess what? The market is always going to end up being right. You can be in a great position at one point, and then some type of news comes out and it automatically gets away from you. Let me give you a perfect example. Yesterday, I ended up trading the Euro New Zealand, and this was a long-term trade for me. This is something that I was looking at and thinking that there's 1,200 pips to the downside. And I still think there's 1,200 pips to the downside that it can be able to move. However, once I ended up getting into the trade, I was automatically up. And then after that, because of economic news and because of the negative situation that ended up happening, automatically popped up and I ended up hitting my stop loss number. Now, my stop loss number was 200 pips away. Let's think about that. The market moved 200 pips in one quick setting overnight because of the interest rate news that ended up happening. So if I wouldn't have had that trail stop in that area, then I would have lost way more than what I actually end up was planning to lose by not having that trail stop or not having that stop loss. So just keep that in mind. That's something that's very important. That kind of brings me to my second thing. Always be aware of economic news. And if you're inside of a trade, especially if you're making money or if you already have capitalized on a movement within there, I would probably urge you to just take your money out of it and wait to see what's going on with the economic news. Now, unless you're 100% sure about where the market's going to end up going and you're in that trade knowing that it's going to end up going in that direction, or you have some type of trading style that's built based off of economic news, I wouldn't even worry about trading with economic news and listening to it until 15 minutes after the news has came out, so you have an idea about what the direction is going to end up being. Most news basically whipsaws, so it means that it's going up and it's going down at the same time. So it's taking people that end up buying out and it takes the people that end up selling out, and then after that it gives a clear direction from there. So to me, as a trader that's just getting started, I wouldn't even think about trading economic news, just because I want to be able to get a clear direction about what the trend is actually doing. And then after that, then I make my decision on how I'm going to end up trading. The last thing that I want to end up talking about is this, and this is another thing that's before the trade. They always say that the trend is your friend, but how do you find the trend? How do you find direction when it comes down to where the market is actually moving? It's very simple, and you can look at it in 3 different things. I personally use higher time frames to gain direction about where the market is actually going. The higher the time frame, then that means that it's a clearer picture about where the market is going over the course of years and months. And so it gives you an idea about how you should be trading on lower time frames. One indicator in particular that I use is a stochastic RSI to be able to see how the market is actually moving from there. Now, in my case, if the stochastic RSI is very cloudy and it's not giving me a clear direction, then the next thing that you should be looking at is some type of moving average. If you look at the 200-day moving average, then it's based off of what's the trading action over the course of the last 200 days. Now, the stochastic may be cloudy, but the moving average may end up giving you a clear direction about where the market is going. Typically, if the candlesticks are above that moving average, then it's bullish, and if it's below, then it's bearish. So it gives you an idea that, hey, I should be trading towards the upside and not looking at trying to sell on any type of trades, because I'm actually trading with the actual trend. Now, the last thing that I'll possibly end up using, and I use it all the time, is a momentum indicator. Being able to have a momentum indicator will end up telling you that there's some movement that is about to happen, or there's no trend at all, and you probably should stay away from it until it ends up having momentum. Because if there's no momentum, then there's no movement. And it always remains the same. If there's no momentum, then there's no movement. One good indicator to be able to use is the ADX, and I'm going to have a desired video based off of that on one of my other trading pages, and I send you the link to that so you can be able to see it. But by being able to use a momentum indicator like the ADX, then it'll give you an example about when the market is going to end up moving and when it's starting to get into that trend, so you can get into it early and ride the wave until it starts fading off and the trend starts to die off from there. But if I provided value to you in this video, please make sure that you end up sharing, subscribing to the trading platforms and everything that we have going on with Carter Cow Capital. And until then, trade your plan, plan your trade, trade your plan. Y'all have a good one.